While you're reading this disclaimer, don't forget to subscribe, tap that like button, and if you're fortunate enough to have a parent still alive on this planet, call or text them that you love them. What's up, trading family? Welcome back to another trading video on our trading basics. I'm just going to see how many times I can say the word trading in the intro here. We're going to talk about common trading terms today, and this is going to be a super important video, one you're going to want to reference many times. I will preface all my videos as usual, though, with, again, this is not financial advice by any means. This is purely for educational purposes only. And on the next slide, as usual, I do mention that if you are watching this on YouTube, please click the link in the description to access the free members area, so you can get access to slides of all of these videos, any of the free courses that I give away. All the slides are available for you to to flip through right in our members area, as well as any PDFs, guides, checklists, anything else I come up with there. Any other resources in the free trainings are downloadable only in the members area, not here on YouTube. So again, make sure you get a free account there, and you also get notifications of when I do free live trainings. So if you want to look over my shoulder while I do live trainings, make sure you register. And don't forget to like and subscribe, as they say. So we're going to go over like a couple dozen different terms today, all of which I use. So if you're not familiar with trading, this is going to be a great video. The first term we're going to go into is the time frame. This is when you're looking at a chart. It's the chart interval itself that's being viewed and analyzed. This is going to be at the top left of your trading view chart. If you're using other softwares to be able to trade on, again, it's going to differ. I use TradingView, so this is where it is. At the top here, I've got some ones saved here. You can see there's a kind of a drop down here on the right-hand side of if you have any default ones here. But you can see, hopefully you guys can see my mouse in this, whatever. But there's a drop down. Any ones that you add a star onto will be added to this upper section right here, kind of these hot buttons, shortcuts. But if you want to just pick them individually, they have a drop down here for you to pick that time interval. Next, price action. This is just a simple term in terms of the study of price movement without indicators. So again, it's just the way that the price is moving on the charts, period. Support. This is a price level where the downward movement typically stalls. You'll hear me use an analogy about a bouncing basketball. This is the floor. And as you can see, the price is, gone up from here, back down, hits the floor, hits the floor, hits the floor, hits the floor, hits the floor. So this is an example of a support level. The antonym, the opposite of that is resistance. So again, support, floor, resistance, ceiling. This is typically where the upward movement can stall. So again, it's the same chart. There's a support and there's a resistance here. So again, support. Kind of drew a green line here for you to see that. The ceiling is where the price seems like it keeps hitting and keeps hitting and keeps hitting and bouncing back down. And some people will try and trade this. This is when it's called a range. We'll go over range again here, I think, in the next slide. Yeah, range. So the area between the support and resistance levels, especially if it's a small area, is called a range. And you'll hear people use the words like consolidation. You'll hear the chop. I do not like to trade the chop, because some people, like, after a couple of bounces, will be like, okay, well, as soon as I see a green candle, I'll get in. But then you don't know where it's really going to bounce down. You know what I mean? And your risk rewards get a little tight in that. It becomes a little bit more of a risky scenario, in my opinion. That's what a range is. So volume is the number of shares or contracts traded in a period. I went and added an indicator at the bottom of this same exact chart to show you the volume, the number of trades that came in. So you can see down here this big green candle on the far left-hand side at 2200 hours right here. This candle right here spiked the volume, and that looks like this is gold futures. So I don't know if this was a Tokyo or Australian market changing those futures or whatever, but there's a lot of volume in this particular 5 minutes, it looks like 5-minute time frame, that helped drive the price up. And you can see that here, low amounts of volume moving the price around, and again back around here, a lot more higher volume. And as you can see, as we get closer to 9, it'll be 9:30 right here. The graph cuts off probably before it spikes in one direction or the other, because that's when the New York markets open, and you'll see higher volume in higher volume markets. Yes, and what I mean by that is, if I was a Forex trader and I was trading USD JPY for the United States dollar Japanese yen, we're going to see bigger spikes during New York or Japan's market being open. You're not going to see it as much during European. Are you still going to see trades and some movement during there? Sure, but the volume might not be as high. I like to trade during decent volume, so I know that my trades will open and close accordingly. So again, that's what volume is and why it's important. Liquidity. I threw this image in there just to be silly. Liquidity has nothing to do with water. It's the ease of buying and selling without significant price impact, which means that you can enter and exit trades without you manipulating the market necessarily. But really, liquidity is a lot of the times when people have their stop losses or their take profits, those are what's called limit orders. And those are public, open orders that people can see pending. And what happens a lot of the times is in the case of, let me see if I can find another thing here. So in the case of something like this, a lot of people are starting to sell, and they'll put their stop losses at the top of these pullbacks, again, having gone through the pullback in there. But that means there's a lot of liquidity above here. So what ends up happening is the price gets driven all the way back up, and it takes out all of the liquidity of all these pending orders of people's stop losses from back here. Again, if that doesn't make sense, keep watching all the videos. It will make sense as far as that goes. And what you don't want to be is the liquidity. A lot of the times, people will enter trades, and they don't enter them with the proper criteria, and they get stopped out pretty quickly, which means that you just gave that money to the markets. You were the liquidity. Don't be the liquidity. So next, again, I did mention this consolidation. This is the price moving sideways in a range, showing market indecision. The buyers and the sellers are fighting and duking it out. I kind of relate this to like ping pong, back and forth, right? Which way are we going here? And I don't like to trade during consolidation typically, but it also typically doesn't last as long as it does on this graph here. Now, an order block. I talk about this a lot because B is the letter B in BIT in my BIT method, which is what I use. It's my method, my whole strategy around trading. An order block is an area where significant buying and selling occurred. You can see I have these order blocks marked out with red boxes right here. This bottom one was the last area of selling before a huge push up. So that means this order block here represents the start of a large number of buyers coming into the market. The buyers start to die off here, get to like lower highs, and lower lows. And then right here is the last push up before we see a huge sell-off in terms of those sellers coming into the market, right? So trading between these order blocks is incredibly effective. There's strategies for when you're about to approach an order block. There's a strategy for when you're in between order blocks, and everything in between that. So again, using this is allowing you to trade with the institutions, the hedge funds, and the banks to make sure that you're trading kind of with the stream as opposed to trying to swim against it. It's much easier to do this instead of you being the liquidity in the marketplace. Next is trend. Again, this is overall price direction. It could be upwards, downwards, could be sideways. You see here I kind of drew ovals around the consolidation areas, and then the trend up or trend down. And again, in previous videos I mentioned an uptrend is bullish, and then bearish is a downward trend. A channel. This is a long definition, but a visual representation on a price chart where an asset's price moves between two parallel or close to parallel lines, in this case, indicating that a range within the price is likely to fluctuate. Again, you're going to have ups and downs and ups and downs and ups and downs in here, but, and again, this is going to be the lower resistance, the upper line representing the resistance line and the lower line representing the support. So again, support and resistance might not necessarily be flat lines. This could be a channel in either direction, either bullish or bearish. Essentially, a price range where the asset is considered to be trading within a defined trend. Break of structure, BOS. I do talk about this quite a bit as well. This is when price breaks previous high and lows, signaling a potential trend change. And you can see here that there was a range. It kind of went as high as here, as low as here, bounced up as high as here, as low as here, went up a little bit higher, but then it died, kind of died off again. Didn't quite go as low as here, so we're in a further consolidation in this area than we were in even over here, but it looks like the buyers ran out of steam. Nobody was getting any higher than this support, this resistance level. Drop down, hit the support level, tested back up, didn't come close to this resistance line. Matter of fact, there was a new resistance line that looked like it formed here. Came back down, broke our low, never came back up to break any highs. Broke this low support again, not quite as low as that. The high didn't come back up again, and then finally dropped. And that break of structure down and lack of buyers coming into the marketplace signaled that, hey, we might have had a big buildup to get to this area of consolidation, but the buyers are slowly going away and the sellers come in. Price tanks, and if you're shorting here, you are a happy puppy. It's sort of that way you're making some money. Now, next is a pullback. A pullback is a temporary price retracement against the main trend. That's a lot of wordsmithing. That's a lot of word spaghetti right there. But all that means is, okay, the trend's going down. The pullback is when it goes slightly up again and then continues in that downward path. It goes slightly up, it pulls back a bit, and then it continues down. And these are great ways to get entries when it starts to pull back, and then it reconfirms that it's continuing along with the trend. Great. That's in the BIT method, BIT. I, for the indicator, our indicators usually look for stuff like this, and this is one of the things that we use in conjunction with my King's Kloud indicator to represent a good entry in a trade and a very valid way to make some money in the markets. This is a little bit heavier in terms of pullbacks. You can see that this is probably a bigger time frame than the last one, maybe. No, it looks like it's less of a time frame, but for whatever reason, like we're seeing a little bit more wicks. Maybe I should have zoomed out a little bit to get to more wicks in the picture. But long story short, this one's trending up, so it's bullish. The pullback is going to be in red instead of green like in the last one, because again we're trending up, green, 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 red pullback, green, 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 red pullback, green, green, kind of a pullback. And then, again, a continuation along with the trend. So, again, pullbacks are a great way to identify entries. A breakout, this is when price is moving beyond an established range. So, again, like it could be this one down here. It could be like a couple before. This was a break of structure here, here, and here. This would be considered the breakout. Whereas here, we had a slowdown of the sellers. All of the momentum started to go up. So right about here is when it looks like the momentum started to change directions into the upward bullish direction. It broke a structure here, and then this became the huge breakout. And trading this breakout, again, would have been a huge profit. Next is risk-reward ratio. This is the potential profitability of an investment or trade by comparing the potential reward, profit, to the potential risk, loss, essentially showing how much potential gain exists for each unit of risk taken. It's calculated by dividing the potential profit by the potential loss, often expressed as a ratio. Example, 1 to 3. So meaning for every dollar you risk, there's a potential to gain $3. I love these. Where, again, I might be trading $100. My goal is to make $300. If I'm trading $1,000, my goal is to profit $3,000. And if I break even, great. That's a one to nothing. You know what I mean? That's a zero. I didn't risk or reward anything. A 1 to 1 is good. You risk 1,000, you profit 1,000. So you had 1,000 in your pocket, you now got 2. Right? So again, these are all things that we consider. And, what is a good risk-reward ratio? It depends upon your trading style and your risk tolerance. For me, I'd much rather have a lower risk-reward ratio, or 1 to 1, a 1 to 2, 1 to 3, to start out my day where the volume's a lot higher and it's a little riskier in the marketplace. I'm happy with a 1 to 3, even a 1 to 4 is phenomenal, right? At the same time, as we get more into a less volatile marketplace and the direction that the price is going is maybe a little bit clear after the morning range, the first hour and a half or so, or it could be 45 minutes to an hour and a half of the market being open, a trend usually will form, and then you might be able to have a smaller stop loss, which ultimately could mean heavier risk because the price fluctuates, it takes you out of the trade, and you use that risk. But you have the potential for a lot higher risk-reward ratios. Again, more risk, but more reward, potentially. And again, I go through a lot of these examples throughout the rest of my courses, so make sure you like and subscribe and comment down below with any other feedback or other videos that you want to see. Entry, this is the price at which an investor initiates a position in a security, i.e. when you enter the trade. An entry is an entry into the trade. I can't use the word to define it, but that's when you commit to the trade and you hit that button that enters you into that trade. So hopefully that makes some sense. In this case, this is a short, a sell. The entry, again, is right at this line right here. your risk is the red section, the reward is the green section. Likewise, when you're buying, again, this is your entry right here where the green and the red colors match. This line right here would be your entry point. And naturally, I'm going to use the same graph to do the same terms. This is the order. Your stop loss is an order to limit potential losses. It's called a limit order, and it's a type of limit order called a stop loss. And this means that whatever the number of units is between here and here will vary depending upon what you're trading, and the value of that. The total value that you want to actually risk, again, if this is $100, you need to divide that $100 into the number of units you have to buy. The good news is with TradingView, the order system does the math for you. If you want to risk $100 a trade or a certain percentage of your account, you can change that when you're placing the actual order, which is great. So again, it's the order to limit potential losses. If the price was here, and instead of coming down, it comes back up and it passes that line at the top of this red box here, that's your stop loss. You would be taken out of the trade and you'd lose that whatever amount that you risk in that trade. Likewise, the take profit is in order to secure gains at a predetermined level. This could be, around another area like an order block. It could be after a certain number of risk-reward ratio. So as soon as I hit a 1 to 3, and I think both of these cases, I wanted to leave the trade. Now, if I had, in this case, just moved my stop loss up and trailed it behind these little pullbacks here, I might have been able to have even more profits than this 1 to 3. As a matter of fact, if I had stayed in the trade and just exited up here, instead of a 1 to 3, it might have been a 1.1 to 3.5, something along those lines. Note, after entering a trade, you can move your stop loss. Like I said, it's a trailing stop loss, and you can and also move your take profit levels. So I might have a trade that's set at a 1 to 3, and I'm like, wow, there's a lot of volume in the marketplace. Let's see how high this goes. I might move my take profit higher to an order block, to a level of resistance, or a little bit before the level of resistance to make sure the trade executes, right? And then as the price continues up, I'm just moving my stop loss behind some of those pullbacks to make sure that I'm maximizing how much I'm earning on a trade. Next one is drawdown. This is a decline during a specific period for an investment fund or trading account. So if you're risking $100 for a trade, if the price is in between your entry and the stop loss, you are now in drawdown. This means if you exit, you'll lose up to that $100. When you hit the stop loss, you'll lose the $100 in that case. If you're like, you know what, this looks like it's going against me. I want to get out of the trade even before the stop loss because I'm seeing a lot of momentum up. You get out of the trade. This is why you typically don't want to enter the trade at the bottom. This is why you want to wait for the pullback, get a confirmation that it's still heading in the correct direction, and then get in the trade. I hate being in drawdown as well, and it's that area where you're just like your stomach's starting to churn and you got to wait, 2, 3, 4, 5 minutes sometimes in drawdown to see if the price bounces back. And I have specific rules around, am I going to even stay in a trade? Do I exit out at half of a stop loss or what, depending upon several factors. So again, it's good to have trading rules, but we're not going over that in this video. This is just strictly speaking terms, industry terms and definitions. So that's what drawdown is. Now we're getting into some of my unique phrases that you're going to hear me say in these videos. King's Kloud. This is my premium indicator that displays the trading momentum trends, buying or selling. When the trend changes, it'll notify you on that, or it'll, there's an indicator. The indicator symbols will show you that and more. This gives the trader an indication of what type of trade they should be entering, long or short. And which direction that momentum is. Again, if you had to choose one trading indicator, this is it. This is the I in the bit method, BIT. I stands for indicator. The indicator that I'll be referring to is King's Kloud. And as it stands right now that I'm doing this video, that is going to be available usually only to my coaching clients and stuff. But again, I haven't even decided to open that up yet. We'll see. We'll see what happens. I'm just putting these videos on YouTube for the heck of it. But right now, that's again my proprietary premium indicator. I'll more than likely be sharing this with people if they want to learn more from me. So I'll share a link with you in due time. So King of Diamonds, this is a feature in the King's Kloud indicator that indicates the potential reversal of a trend. I can see here, again, this red cloud means the price over a large time frame. A bigger trend is still in a downward direction. there was a temporary uptrend right here with this smaller green cloud, and then boom, right here, this red king of diamonds appeared and indicated like, hey, by the way, the momentum has slowed. You might be wanting to look for a sell pretty soon. I saw this come up. I realized that the buyers were starting to slow down in the marketplace. I got in the trade maybe a little bit early. You know, I had maybe 50% drawdown at one point in this trade, and then it went down, right? And you can see I moved my stop loss here. If this trade continues down, make even more. Probably got a 1 to 3 out of that. Really great trade. Really happy with that one. But that King of Diamonds is right there. So Royal Bloodline, this is another feature in the King's Cloud indicator that calculates, it's roughly the average price. There's a few other factors in there. Again, it's my kind of proprietary formula kind of thing, but it's as well as the momentum. So again, we went over this red cloud. The King's Cloud is the name of the indicator. We went over the King of Diamonds. Again, that could be green or red for upward or downward direction accordingly. But there's this other green and red line, this thin line here of the price. That is, I kind of call the Royal Bloodline. That's a dumb, corny name, but I needed to come up with something that had to do with royalty for my brand around King Capital Trading and royalty and that line. So I was like, Royal Bloodline? So amazing, huh? So I think we're getting close to the end. Yeah, so and Royal Flush. Royal Flush is basically just looking through your confluences, looking at the check boxes. When 2 or 3 of our confluences occur at the same time, it gives us a reason to enter a trade. So if I see order blocks, indicators, or trends checkboxed, if 2 of the 3 or all 3 are checkboxed, that means, hey, this is a great time to enter that trade. Some of my biggest risk-reward ratios and biggest earnings have been when I've been able to check all 3. The chances of you being in front of your computer at the exact moment that all 3 of those are happening are rare, but it does happen. But getting like a 1 to 20 type risk-reward ratio is nuts, right? That being said, if you're able to see a B and an I, or an I and a T, or a B and a T, you're awesome. You're in great shape. It's a great time to enter that trade and start making some money. So again, guys, save this video. Come back to reference this again and again. And don't forget to access our free members area. For all the slides, click the link in the description. Get a free account in that members area. Get access to these slides and all the other free resources that I have back there. So I think that is it. Yep, that is it for this particular video. Hope you guys enjoyed it. Again, bookmark this, save this video, come back to it time and time again. And don't forget to download the other resources. Like and subscribe. We will see you guys in the next video. Looking forward to it.